studying your last two. I swim med when they turned in. The styren down to mute. And can learn the pole that sunk he died.
In this section, we move into one of the most important tax planning concepts in corporate taxation: expense allocation. The corporation in this example earns income from two different sources. On the left side, we have active business income, often called ABI. This income comes from the corporation's normal business operations, such as serving customers, employing staff, and selling products or services. On the right side, we have investment income. This may come from stocks, interest, rental properties, or capital gains generated by the corporation's investment portfolio. At first glance, it might seem that a deductible expense produces the same tax benefit regardless of where it is claimed. However, that assumption is often incorrect. The key issue is that these two types of income are frequently taxed at very different rates. In this example, active business income is taxed at a much lower rate of approximately 12.5%, while investment income is taxed at a much higher rate of approximately 50.17%. Now look at the question in the center of the slide. The corporation has incurred an investment advisory fee of $4,780. The important question is, where should that expense be deducted? If the expense is deducted against active business income, the corporation receives a deduction at the lower business tax rate. If the same expense is deducted against investment income, the corporation receives a deduction against income that is taxed at a much higher rate. As a result, the tax savings can be dramatically different, even though the expense amount is exactly the same. This is why expense allocation matters. Whenever a corporation earns both active business income and investment income, tax preparers must carefully determine which source of income an expense relates to. Direct investment expenses generally belong with the investment activity that generated them. The key concept at the bottom of the slide summarizes the entire issue. When different tax rates apply, the location of a deduction can significantly affect the corporation's overall tax outcome. Understanding this principle is the foundation for making tax-efficient allocation decisions and ensuring that corporations do not pay more tax than necessary. In the next slide, we'll compare the actual tax savings that result from deducting the same investment expense against active business income versus investment income. Now let's quantify the impact of expense allocation and see why this issue is so important in corporate tax planning. In this example, the corporation has incurred an investment advisory fee of $4,780. The question is simple: where should that expense be deducted? On the left side of the slide, we see the first scenario. The investment advisory fee is deducted against active business income, or ABI. The corporation starts with $100,000 of active business income. After deducting the investment fee, the remaining ABI becomes $95,220. Because active business income is taxed at a relatively low rate of 12.5%, the tax savings generated by this deduction are also relatively small. The calculation is straightforward. $4,780 multiplied by 12.5% produces tax savings of approximately $598. While this is still a deduction, it is not the most tax-efficient use of the expense. Now let's look at the right side of the slide. In this scenario, the exact same investment advisory fee is deducted against investment income. The corporation earns $15,800 of interest income. After deducting the $4,780 investment fee, net investment income becomes $11,020. But here's where the difference becomes dramatic. Investment income is taxed at a much higher rate, approximately 50.17%. As a result, the same $4,780 deduction now produces tax savings of approximately $2,398. Notice that nothing changed except the location of the deduction. The expense amount is identical. The corporation is identical. The only difference is the income source against which the expense was deducted. And yet the tax savings increased from roughly $600 to almost $2,400. This illustrates one of the most important principles in corporate tax planning. Direct investment expenses should generally be matched to the investment income they were incurred to earn. Doing so creates proper income matching, more accurate reporting, and often a significantly better tax outcome. As tax preparers, our goal is not simply to claim deductions. Our goal is to ensure that deductions are allocated to the correct source of income so the corporation receives the maximum benefit allowed under the tax rules. The key takeaway from this slide is simple. The same expense can produce very different tax results depending on where it is deducted. Proper allocation can mean the difference between a modest tax benefit and a substantial one. In this slide, we move from theory to practice and focus on the actual process of allocating expenses when a corporation earns both active business income and investment income. The first step is identifying the expense. Whenever you encounter an expense in the accounting records, ask a simple question. Why was this expense incurred? Was it incurred to support the day-to-day business operations? Or was it incurred to earn investment income? The flowchart in the center of the slide illustrates this decision-making process. First, identify the expense. Next, determine the reason for the expense. Then ask whether the expense has an investment purpose. If the answer is yes, the expense should generally be allocated to investment income. At the same time, it should be removed from business expenses to ensure it is not counted twice. This final step is extremely important because one of the biggest risks in this area is double counting. On the left side of the slide, you can see examples of expenses that are typically associated with investment activities. These include investment management fees, portfolio management fees, investment advisory fees, interest on investment loans, custodial fees, and investment account fees. These expenses exist because the corporation owns investments and is attempting to earn investment income. On the right side are examples of expenses that normally belong to active business income. These include employee wages, office rent, advertising, business insurance, inventory costs, and operational vehicle expenses. These costs support the corporation's business operations rather than its investment activities. One of the most important sections of this slide is the red warning box at the bottom. This illustrates the double deduction trap. Imagine that an investment advisory fee is deducted against investment income, but the same expense is also left inside general business expenses. The corporation has now effectively claimed the same deduction twice. This can lead to understated taxable income, incorrect tax filings, CRA reassessments, audit exposure, penalties, and interest charges. As tax preparers, we must ensure that every expense appears in the correct place only once. The CRA review checklist on the right provides a useful framework. Ask yourself, are the investment expenses clearly identified? Is supporting documentation available? Is the allocation method reasonable and defensible? Have duplicate deductions been eliminated? And has the most tax-efficient treatment been considered? The key takeaway from this slide is that expense allocation is not just an accounting exercise. It is a tax planning exercise. Whenever a corporation earns both active business income and investment income, identifying which expenses belong to each income source becomes critical. A properly allocated expense can improve tax efficiency, while a poorly allocated expense can lead to missed tax savings, audit risk, and costly reassessments. The best practice is simple. Identify the purpose of every expense, allocate it to the correct income source, and make sure it is deducted once, and only once.